Welcome to the Calgary Mortgage Minute on calgarymortgage.com. Thanks for tuning in and taking the time to watch this video. Today we're going to talk about interest rate differentials as well as the trick that banks use in order to make your interest rate differential or your payout penalty significantly higher than what it could have been. So let's start by talking about how our interest rate differential works in the very basic sense. So let's say you have a 5-year mortgage and the mortgage that you started with had a 3.29% interest rate. And you decide that you want to sell your house or refinance and pay the mortgage out. And let's also assume that you have about 2 years left on the mortgage. Well, the way that they calculate the interest rate differential is by taking the 5-year mortgage rate that you had, 3.29%, and comparing it to the term closest to the amount of time that you have left. So in this case, it would be the 2-year mortgage term. The 2-year would be at 2.29%. The difference between those two rates would be about 1%. So actually, forget about 1%, it's exactly 1%. So on a $300,000 mortgage, you'd be looking at about $3,000 per year. 2 years left, you'd have about a $6,000 payout penalty. Pretty simple to understand, right? So why is it that sometimes we see bank clients come to us with significantly higher payout penalties? Well, let's take a look at a little trick that the banks like to use to inflate this number from $16,000 or $6,000, to a significantly higher number. It's actually interesting because what they use is a trick that's designed to make you feel good while you have the mortgage, but make you not feel so good when you get that payout penalty calculation. So what they do is they use their posted rate to determine the discount that they gave you. So in this case, let's say the posted rate at the time you got your 5-year fixed rate mortgage was 4.79%. Well, because they gave you this special deal of 3.29%, they are going to say every single year when you get your mortgage statement that you got a discount of 1.5%. And, for the first few years, you're going to feel really good about the fact that you got that discount. But then what happens? Payout penalty time comes around, you decide you want to make a change to your mortgage, you want to move, maybe something happens where you need to get out of the mortgage health-wise or whatever life takes, whatever life happens causes you to need to get out of the mortgage. So what the banks will do is they'll say, okay, well, you've got this 1.5% discount and you've got a 1% difference between your 5-year fixed and the 2-year rate that's remaining. So we're going to actually calculate your payout penalty as though it's based off of 2.5%. So instead of it being $3,000 per year that you would owe them, it's $7,500 per year. 2 years left on the mortgage, and all of a sudden your payout penalty went from $6,000 to $15,000. Pretty tricky, right? You got a discount, but in the end, that discount comes back to haunt you. So the question is, how do you avoid this scenario? And it's really quite simple. Let's call a spade a spade. Every mortgage in Canada basically comes from funds provided by one of 6 places, the big banks. So a lot of times when you end up dealing with a lender like First National, Merrick's Financial, MCAP, or any other lender that you may not recognize the name of, the chances are that the money that you're using to get that mortgage or that's being lent to you is actually being sold off to one of the big banks. The difference is those smaller lenders, those monoline lenders that only sell one thing, and that's a mortgage, they don't have this posted rate. And because they don't have that posted rate, they don't have the discount. And because they don't have the discount, what ends up happening is instead of your payout penalty being that $15,000, it ends up being that lower $6,000. So the way to figure this out, the way to get the best mortgage possible is to get good, honest opinions. The best opinions, the best advice typically come from a mortgage broker. And you know what? Don't take one mortgage broker's word over it. Get second opinions, get multiple opinions. Go to your bank, go to multiple brokers, figure out where the best deal is. And at the end of the day, hopefully you'll avoid the payout penalty nightmare.